All right, let's just get right into it. It's the question pretty much all of us have asked at some point, especially around tax time. Can I please write off my gym membership? I mean, you're trying to stay healthy, right? Maybe your doctor even told you to get more exercise. So what's the deal? Can you actually get a tax break for it? Let's find out. Well, the short answer is it's really complicated. You see, the IRS has a very, very specific way of looking at your health expenses. It's not a simple yes or no, but if you understand the logic they use, you can figure out the real answer for your situation. So it all comes down to this one core idea in the tax code. The IRS basically splits the world into two camps. On one side, you have healing expenses. These are for treating a specific diagnosed disease. Those are potentially deductible. On the other side, you have living expenses. Stuff you do just to stay healthy and feel good. The IRS considers that personal, so it's not deductible. And for a very long time, your gym membership has been stuck firmly in that second category.
And that brings us to the first major roadblock, a legal concept that the IRS uses like a giant firewall to block most of these claims. It's called the General Health Doctrine.
Here it is, the core philosophy right here. If something is just good for you in a general way, it keeps you fit, helps you de-stress, makes you feel better, the IRS says, that's great for you, but that's a personal choice, not a medical treatment. You just don't get a tax break for simply trying to maintain your health.
And believe me, this isn't just some dusty old rule. It has been fought over in court again and again. Let's look at a couple of real-world cases that show you exactly how tough this doctrine really is.
You gotta hear the story behind this one. In a case called Kelly v. Commissioner, an accountant argued that he needed a home gym to have enough stamina to get through the crazy busy tax season. You know what the court said? Basically, nice try. They ruled that being healthy is an inherently personal benefit, and you can't deduct the cost, even if it helps you do your job better.
And if you think that was tough, check this out. In Colbert versus Commissioner, a security guard argued that he needed his gym membership to maintain an imposing physique for his job. His body was literally his tool. And again, the court shot it down. They said the general health benefits couldn't be separated from the job requirement. So the takeaway is pretty clear. The IRS does not care if being fit helps your career. They still see it as a personal expense.
For years, that was pretty much the end of the conversation. But then, in 2002, something happened that really seemed to shake things up. It was a major pivot from the IRS, and it definitely gave people a little glimmer of hope.
So here's the big shift. Before 2002, the IRS treated obesity as just a lifestyle choice, something cosmetic. But with a new ruling, they officially reclassified it as a disease. Now, this was a huge deal because remember, the tax code allows deductions for treating a disease. This new rule definitely opened the door for deducting the fees for specific weight loss programs, as long as a doctor prescribed them to treat diagnosed obesity or something related, like hypertension. But, and this is a really big but, it came with major exceptions. You still couldn't deduct the cost of diet foods, and it absolutely did not mean that general gym memberships were suddenly deductible.
In fact, for gyms, this ruling kind of made things even harder. To even begin to think about deducting your gym membership, you have to pass two incredibly strict tests. First, the sole purpose test. This means you're going to the gym only to treat that specific disease. And second, the but-for test. You have to prove that you would not have joined that gym but for having that medical condition. So if you also go to see your friends or just blow off some steam, sorry, you fail.
Okay, let's just pretend for a second that you are a superhero, and you somehow pass those impossible legal tests. You still run smack into a giant brick wall. The simple, cold, hard math of today's tax laws.
This number right here, this is the first part of that brick wall. For 2025, this is the standard deduction for a married couple. What that means is, to get any benefit at all from deducting your medical costs, all of your itemized deductions, we're talking mortgage interest, state taxes, the whole shebang, have to add up to more than this huge number. For most of us, that's just not going to happen.
Oh, but wait, it gets worse. There's another hurdle called the AGI floor. You can only deduct the amount of your medical bills that goes above 7.5% of your income. So the first chunk of what you spend on healthcare gives you absolutely no tax benefit. Let's just walk through a quick example so you can see what I mean. Let's say we have a couple. They make $80,000 a year. Well, their 7.5% floor is $6,000. So if they spend $7,500 on medical bills, including that gym membership, They only get to count the $1,500 that's over the floor. And when you take that tiny amount and add it to your other deductions, it's almost never going to get you past that big $31,500 standard deduction.
So what's the bottom line here? After all that paperwork, all that hassle, the actual tax savings from that perfectly justified gym membership is a big fat zero. For the huge majority of people, trying to deduct it this way is frankly a dead end.
So if the deduction is a complete non-starter, are you just out of luck? No way. There is a much, much smarter strategy, something that you can actually use, and it involves shifting your focus away from your tax return completely.
The real secret weapon here is your health savings account, your HSA, or your flexible spending account, your FSA. This is, without a doubt, the best way to pay for a medically necessary gym membership because you get an immediate tax benefit by using pre-tax dollars. You don't have to worry about standard deductions, AGI floors, any of it.
And the process is actually pretty simple. It's really just 3 steps. First, your doctor has to diagnose you with a specific medical condition. Second, you have to get a formal document from them called a letter of medical necessity. We'll call it an LMN. And third, you just pay for the gym with your HSA or FSA card. That's it.
Okay, I cannot stress this enough. This letter is everything. This can't just be some casual note scribbled on a prescription pad. It has to be specific. It needs the exact medical diagnosis, complete with the official code. It needs the exact treatment, like a gym routine. It needs a time frame, usually about 12 months. And most importantly, it needs a sentence in there that explicitly says this is for treating a disease, not for general wellness.
So why is this letter so critical? Because a gym membership is considered a dual-purpose expense. It could be for fun, or it could be for medicine. This letter is your golden ticket. It's the official proof you show your plan administrator that transforms your gym membership from a personal expense into a legitimate, qualified medical treatment.
So you see, after all of this, it turns out we've been asking the wrong question the whole time. It's not about, can I deduct my gym membership on my taxes? The real question, the one you should be asking your doctor, is this. Is my medical condition serious enough that you can certify in writing that this gym membership is a medically necessary part of my treatment? Shifting your thinking to that question, well, that's the key to the whole thing.